Hi, Shri Sakamoto with Calder Real Estate Group here with the September market update for 2019. So we hear all the news reports that the housing market is going to come down. We've been going up, up, up. What goes up must come down, right? Well, we're in the longest economic expansion in U.S. history. So because of that, they're saying, well, we can't continue to build, 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 build without there being some sort of crash. Um, the recession that everybody is talking about is simply an economic slowdown. And all that means is that for two consecutive quarters, the GDP is lower than it was previously. Does that mean that it is specifically tied to the housing market and prices? No, not at all. So if we look at year over year price changes across the country, California has seen 4.2%. So everybody is saying, well, because we're only going up, our prices are only appreciating by 4.2%. Oh, the housing market is totally crashing. It's over. We're done. That's not true. All that means is that the last couple of years we have seen appreciation in the 8, 9, 10% range. So people's homes aren't appreciating at the same rate. Does that mean their homes are depreciating? Nope. Just they're used to getting gains every year that are up here, and we're not seeing that anymore. The historic norm for appreciation is 3.5% across the United States. So we're at a little bit above that price or range. So are homes going down? No, not at all. We're just not seeing the same appreciation that we have in previous years. And it also depends on where you are price range wise. If you're in a first time, for us it's $300,000 to $400,000. That you're in the low price point. If you're over $1 million, you're in the high price point. So appreciation that we're seeing is different depending on your price point, right? So 5.5%, way above the historic norms of 3.4. And if you're in the over $1 million price point, you're seeing rate appreciation that is lower than the historic norms, but you're still seeing appreciation. If you go to the year over year months of supply, you can see that the higher price points, the over $1 million stuff, is we have almost 4 months worth of supply. Uh, this lower price point is surprisingly high because a lot of the first time home buyers, the millennial buyers, can't see past a home that needs work. So a lot of the supply at the lower price point needs new carpet, it needs new paint, it needs new kitchen, it needs work. And those millennial buyers can't see themselves putting in the work. They want something, they just pack their bags, bring some furniture in, and they're done. Right? So a lot of this lower price inventory is because it's not a fit for who the buyer is at that price point. So that's the explanation for that. Um, you can see that home prices have increased steadily since 2011, creating record amounts of home equity and putting homeowners in a good position to weather future downturns. Are we going to see a crash like we did in 2006, 7, 8? The experts are saying no, we're going to continue to see appreciation, right? We have more equity now than we did obviously in 2011. There was Most of the homes had negative equity. You can see year after year how much equity you've gained. If you bought a house in December of last year, you've already seen $6,400 in equity just with the first quarter of 2019. So now you're looking. A lot of the reports are mortgage debt is at an all-time high, but so is the amount of equity that we have, right? The mortgage debt is higher because people are buying more expensive houses, people are buying more homes, people have 2 or 3 homes. So of course the mortgage debt is at an all-time high, but so is the amount of equity that we have right now. In 2019, where we have $6.3 billion worth of home equity, as opposed to during the crash, it was 2.8, 2.6, 2.4, got all the way down to 2.2 billion in home equity, right? People are not pulling out money to buy Range Rovers or buy jet skis or go on fancy vacations. They're just not doing that anymore. And because of that, we see that our equity numbers are up to all-time highs. So what are we looking at going forward. So they're saying that in California, we're still going to see 8.5% appreciation. Is that going to be everywhere? Are the $1 million homes in Newport Beach going to see that kind of appreciation? Probably not. But overall, as a state, that's what they're saying. That's what they're predicting, um, that we're going to see is 8.5%. The only state that is under 2% is Texas, and that's at 1.9. But across the board, we're seeing 5.2% appreciation, which again, the normal appreciation year over year is about 3.5%. So they're predicting that we're going to see more than above the normal rate of appreciation across the United States, and California is way above that norm. Um, this is just going back to the amount of equity that people have and comparing to what happened in 2006 to 2008. There's 37% of homeowners that don't even have a mortgage. So are we in the same spot that we were back then? Not at all. Not at all. And this was a slide from last month as well, but just wanted to go back over it one more time because I feel like it's so important. Home prices changed during the last 5 recessions. Prices went down 2 times, and one of those two was less than 2%. So they're saying that the recession that is foreseeable in the next year or so is going to be a lot like the 2001 recession. Um, the stock market crashed then, and home prices still went up 6.6%. If you have specific questions about your neighborhood, your home, again, please feel free to reach out. If you're not watching this on YouTube, go to our YouTube channel and you can click on last month's market report where we talked more about why the housing market is so much different than it was during the 2008 recession. Again, if you have any questions, please feel free to reach out to us. Hope you're having a great day. Thanks.